Welcome back to Timmy the Trader, the channel where we teach you how to trade without the usual Wall Street nonsense, and where the goal isn't just getting rich, it's to stop you from turning your account into a donation to bigger players. Today we're diving into a topic so important and brutally honest that many traders will watch the first 5 seconds, blame the market, blame central bankers, blame the moon's phase, and then make the same mistake again by Friday. Yes, we're talking about why so many traders in 2025 are still struggling, and how you can avoid becoming a repeat performer in that circus. Strap in. This one's going to sting, but it will help. Alright traders and chart fans, welcome. This is not a strategy video. It's not how to trade like a pro. And it's not these indicators will change your life. This is the episode where Timmy, yes, me, clears his throat and calls out common trader mistakes. Beginners who panic at every candle movement. Intermediate traders who think adding more indicators will fix their results. Advanced traders who understand markets but not their own behavior. And course sellers who overpromise, this is the truth you need, even if you didn't ask for it. And unlike some strategies you've seen, this one is practical. The first problem: people think trading is about being smart. Let's start with a common misconception. If I just learn more, I'll win more. No more knowledge alone won't fix execution. The market doesn't care about your degrees, your backtests, or how many videos you watched at 3 a.m. If trading were purely an IQ game, many professionals would look different. But they don't, because trading is largely a behavioral discipline. You don't lose because you lack intelligence. You lose because you behave poorly under pressure. The truth: most traders don't have a strategy problem. They have a self problem. You probably don't need another strategy. You need to stop hesitating, chasing FOMO setups, over-leveraging, taking revenge trades, adding indicators arbitrarily, moving stops without a plan, taking profits because you got nervous. You've spent hundreds of hours studying charts and almost no time analyzing your reactions. The difference between losing and winning is execution. A losing trader knows what to do and doesn't do it. A winning trader knows what to do and actually does it. Why your brain is not built for trading. Humans evolved to survive immediate physical threats, not to manage abstract financial risk. We did not evolve to stare at charts for hours, risk money calmly, wait patiently for setups, accept repeated small losses without panic. A red candle triggers the same primitive signals as danger. That's why losses can feel like physical pain and why impulses show up when money is on the line. The 3 types of traders who struggle. 1. Beginner gets excited by every price move, skips stops, and treats social videos as research. 2. Intermediate knows many concepts and patterns, but fails to follow their own rules under stress. 3. Advanced has strong analysis, but can still sabotage results through emotional deviations or poor sizing. All 3 lose for the same core reason: behavior, not analysis. The real reason: you don't make money you can't execute. Analysis tells you what to do. Execution determines results. A good analyst identifies setups. A profitable trader takes the trade, holds to plan, cuts losses as designed, and controls emotions. There are millions of good analysts and far fewer consistently profitable traders. Execution discipline is the key. Hesitation, the silent account killer. You spot a high probability trade. Your analysis is solid, but your mind hesitates for more confirmation. By the time you act, the entry is gone. You then chase or miss the quality move entirely. Hesitation kills edges. Plan entries and accept that not every trade will be available forever. Exciting winners. Too early, the common mistake. You enter a trade, it moves in your favor, and then fear makes you lock in a small gain. Often, the market then continues to your planned target without you. The long-term effect of this habit: your winners are clipped while losses persist, destroying expectancy. Holding losers to long the hard truth. Holding losers in hope of a reversal is one of the fastest ways to erode capital. Widening stops or refusing to accept a loss disconnects you from your edge. A disciplined trader limits loss and preserves capital for statistically better opportunities. Overtrading activity is not edge. Promising to take only top setups and then taking many low-quality trades is a classic trap. Overtrading often comes from boredom or a need for excitement rather than edge. Less is more. Prioritize quality over quantity. Revenge trading, the dangerous impulse. A loss can trigger a desire to quickly recover funds. Revenge trading increases risk and typically compounds losses. When emotions drive position sizing or decision-making, the math of your strategy breaks. Step back instead of trying to retaliate against the market. Decision fatigue, manage your mental energy. Each choice you make throughout the day reduces your capacity for disciplined decision-making. Professionals control this by limiting trades and automating routines. Retail traders who trade all day risk making low-quality decisions as mental energy depletes. Risk management, the foundation. Most retail traders do not treat risk as the primary control variable. Common errors: too large position sizes, decorative stop levels, unrealistic profit targets, treating risk as optional. Professionals ask, how much can I lose? Retailers ask, how much could I make? Change that question. The scared money problem. Trading with essential funds or borrowed capital creates stress that undermines discipline. When money is emotionally charged, decision-making degrades. Trade with capital that allows you to follow rules objectively. Why demo accounts are incomplete. Demo accounts teach mechanics but not the emotional experience of real money trades. Real trading adds fear, pressure, and consequences. Transition slowly, start small, and treat demo as a tool, not a final test. Complexity, keep it simple. More indicators and more rules often equal more confusion and excuses. Simple systems are easier to execute with discipline. Aim for clarity and repeatability. Self-awareness, the most important skill. Understanding your personal trading triggers, when you break rules, and why you react is more valuable than another indicator. Self-awareness reveals recurring mistakes so you can correct them. What professionals do differently. Professionals: follow rules consistently. Risk small per trade. Wait for high-quality setups. Maintain trading routines. Journal and review performance. Avoid emotional decision-making. They prioritize process over short-term feelings. The hardest skill, patience. Doing nothing when there is no edge is a skill. Waiting for the right setup protects capital and allows edges to compound over time. Fixing yourself a practical plan. To improve trading outcomes, build and follow clear rules. Keep position sizes small enough to remain calm. Journal trades and behaviors. Trade less, focus on better setups. Master one system before adding more. Review performance weekly. Treat losses as a normal cost of business. Institutional practices, not mysteries. Institutions succeed because they control risk and follow processes. They do not act on emotional impulses. You can adopt similar habits: consistent sizing, rule following, and careful review. Institutional logic vs retail emotion. An institutional mindset. Identify setup, size small, execute to rules. A retail mindset often juggles uncertain scenarios and emotional input. Systems reduce ambiguity and emotional noise. How retail traders get trapped. Common trap: buying at perceived breakouts, panicking on retracements, closing early, then watching the original move continue. This pattern is behavioral and fixable once recognized. Timmy's transformation. Timmy spent years repeating many of these errors: overtrading, poor sizing, and emotional reactions. The change began when Timmy accepted responsibility and focused on behavior rather than constantly switching strategies. Timmy builds a system. A proper system includes clear entry criteria, defined stop-loss rules, targeting and risk rules, conditions for avoidance. Systems remove subjective decision-making on the fly. Timmy learns patience. Waiting became a skill. Acting only on high-probability setups improved outcomes and reduced stress. Timmy reduces position size. Smaller risk per trade kept emotions neutral and decision-making consistent. When trades feel calm, execution improves. Timmy journals consistently. Daily records exposed recurring errors and allowed Timmy to correct behavior over time. Timmy becomes neutral. Wins did not cause overconfidence. Losses did not cause panic. Emotional neutrality preserves clarity and process. The real secret: consistency. Small edge plus disciplined, repeated execution equals profitability over time. Consistency scales small advantages into meaningful returns. Final lesson: prioritize discipline over smarts. Trading is not an intelligence contest. It's a reliability contest. Do fewer things and do them better. The market rewards consistent, process-driven actions. We've reached the end. If you watched all the way through, you're already doing something many traders don't: learning thoughtfully. This video won't automatically change habits, but it can be the start. Trading cares about discipline, not feelings. If you want to leave the majority who struggle, begin by controlling behavior, not chasing clever ideas. If this helped, like and subscribe, and comment, "I will trade with discipline," if you're committing to change. Until next time, may your entries be clear, your exits logical, and your stops respected. Timmy out.